Hi everyone, Billy here, the co-founder of Trade Prosper, and welcome to section 11, video 3. In our previous section, we spoke about how we're going to look at the option strike and the option premium, and in this video we'll have a look at a real options chain to see how we go about picking the correct strike. So now we'll go and have a look at the options pricing itself. And the idea here is that if the strike rate that we are looking at, the premium due for that strike rate is in line, then we buy that option, if we can afford it. So let's go have a look. Now remember, we're using Morgan Stanley as an example. So let's just for a second pretend we've done the trend trading analysis has already been done. The current spot is 36.5, a little bit lower than where our previous example was worked out. But the point being is, let's pretend as we sit here now, the trigger that we're going to look at, so the channel breakout or the moving average crossover or the price crossing the moving average, is indicating a 36.5 level. And here's what I meant. We're not guessing which strike rate to use. Remember, we are trying to catch the trend in the same fashion the trend trading strategy would have worked. And the trend trading strategy said we have to be in here at 36.5. So we're going to now look and see how much does it cost to buy an option for round about the 36.5 level. So how do we look up an options price? When you go to any of the broking screens, you'll see most of the time you'll have a thing called an options chain, which basically just says it's all the options that's available for that specific security. And what we'll look at in this example is, again, we're going to just look at, we're trading the example of a 55-day channel breakout. So we're going to use an option that is in line with that time frame. So in this example, we can look at either the 42-day or the 36-day. We can even go out as far as the 49-day if we wanted to. But for now, for this example, I'm just going to click on the 36-day, which is January 17th of next year. So remember, we're pretending that this will be a downward break. So in other words, we would want to go short this share. So the way we would do it is by a put option. Now you'll see here that the 36 strike put option costs 99 cents per option. So in other words, that is an option being 100 units. That'll be $99 per share or per option. This $36 is already indicated to us, so there's not a lot of guesswork here. We don't have to look for a strike that we think is best. It's now a comfort level in terms of our risk premium. So if the $36 works for us, so if our risk parameter says we can lose up until $100 on this particular trade, then we're good to go. We just buy the option right here. So the next step in the premium analysis process is, if we have an option strike, in this example, that $36 put option, if that is too expensive, so in other words, the premium that's due is too high in relation to what our risk parameter is, then the next thing is we just look for a cheaper option that is relatively close to that strike. So remember, 36.5 is the underlying spot rate. So if we cannot afford that 36 strike at 99, let's say our risk parameter doesn't allow us to take $100 worth of risk, we can be comfortable in going down, in this example, by 2 strikes. So if this was 36, I'm comfortable trading the 35 or as low as 34. I wouldn't really go past 2 strikes. Similarly, if this was an upward breaking channel, we would have bought the call, which is on this side here. And once again, I will not go up by more than 2 strikes there. So you can see the premium isn't that expensive. And you don't need big accounts to trade options like this. And this one, like I said, is a little bit more tricky than the other ones, because we're kind of bound by the fact that the trend trading technique already indicated 36 as our desired level. So we really want to do one of those 3 options there. But as I showed you, we're not really too critical on the strike, because we're going to be trying to get into a trend. And if this is a downward trend, there's a good chance that it'll go lower than those 3 strikes. So any one of those strikes will be fine. Now, what happens if you come here and, remember I said you can go down by 2 strikes. And if at $34, you still can't afford this structure. So let's look at our case, for example, where we said we have a $2,000 account. 1% risk means that we can only spend $20 maximum on an option. So even 2 strikes lower still costs $43. What do we do now? Now in this instance, what we will have to do is to cheapen the premium in some way. Now, the thing is, in this particular course, we don't cover that strategy. In some of our other courses, we cover numerous ways on how you can cheapen or even make a strategy 0 premium. But for purposes of this course, I just want to give you the concept for now. And in the end, if you really cannot do any of those 3 steps, you have to be prepared to walk away from that trade. Now remember, the market has 1,000 opportunities every single day for you to be part of. You don't have to physically catch every single one in order to be a success. So when you look at everything, you first and foremost evaluate it against your own risk parameters. And if the trade does not work, you don't force it. You never ever force a trade. You literally just walk away and look for the next one. As easy as that. So up until now, you've actually only seen option prices that are fairly high. I mean, I would look at this and say most of the examples had option premiums of around $100. And I understand that many of you start with smaller accounts. So the question here is, can you do some of these things with options that are actually within your budget? So in other words, we don't have to do any of these fancy footwork to try and manipulate the premium or make it 0 premium structures or anything. So I thought I'll just show you something here. The option prices are pretty much related to the share prices. So when you have a very expensive share, you can kind of expect the option prices to also be a little bit more expensive. But I wanted to show you that without doing any adjustment to the price, there definitely are shares that you can use that have a premium below $20. So even if you have an account of $2,000 and risking 1% only means you can only spend a maximum risk of $20, there's a ton of trades that you can do. Now, the reason why I'm only showing you share examples is because most currency trading platforms have a minimum portfolio size of $10,000 required before you can start trading currency options. So I've just kept the example to a broader market because I know many of you don't have account sizes that big. So I wanted to show you that there definitely would still be options available for you to use. So let's have a look at this. I randomly picked a share, Bank of America. It's currently trading at about $17. And I want to give you a feel of what the premiums look like for Bank of America. So let's go have a look. All right, so here you can see Bank of America currently trading at $17.13. So if we pretend here that we now got a same trend signal here, I want to show you that there are strategies here that fits any budget. So let's look at the pricing chart here. So this is for expiry January 17th, which is a 35-day option. So it's pretty much the same type of structure or same type of option that we've been looking at all throughout this section. And I wanted to show you here that, remember, with the share price trading around 17, a $17 put costs $46. Remember our 3 premium evaluation scenarios? If the premium at the breakout level works for you, then you trade it. So if the breakout level is around $17 and you can afford $46, then you just buy that option at $46. But remember, in our example, we're going to use an account size of $2,000 where our 1% risk says you can only spend $20. And look here, we only have to drop by 1 strike from 17 down to 16 and we can afford this option. Now there's one thing I want you to avoid doing. And I must say, this is one of the key downfalls of new option traders or investors, or rather novice investors in options or using options. And that is that you shouldn't just buy options because they are cheap. There's a reason why they are cheap. Now let me just go show you something on Bank of America again. Can you see that if we look at, wow, look here, from $11 onwards or lower, so this is a put option on this side, you can see that buying a put option at $11 cost $2 only, because this is 2 cents times 100 is $2. A $12 strike also costs $2. Now, the point being here is, and this is a little bit more info than what is required for this course, but options are very accurately priced in terms of probability. And if you buy something that is that cheap, there's a very good reason for it being that cheap. And I almost want to equate to it as it's like you paying for car insurance in case you bump into an elephant. And this is while you are living in New York City. Now, the point is, with New York, anything can happen. So there is a slight chance that might happen, but it is highly unlikely that you'll be bumping into an elephant with your car while driving in New York City. So the reason why that thing is so cheap is the chances of it happening is very, very remote. Now, people have made a ton of money on what they call black swan events. Now, what a black swan event is It's an event that most likely or statistically would never occur. And if you buy very, very cheap options and Bank of America falls to zero, you'll make a ton of money. But the point is, you can't use that as a successful strategy continuously. Certainly not at the level of this particular course that we are addressing here. So I just want to bring this to your attention that this definitely is something that you should avoid doing. You shouldn't be buying options that are cheap just because they are cheap and because you can afford a ton of them. And if the market is by chance going in that direction, you'll be a millionaire. That's not the point here. There's a reason for it, and hopefully by now you understand the concept behind that. Okay, so if I can summarize everything from section 11, it'll be this. The strategy that we use to avoid being stopped out is a frame of mind strategy. We're not trading options. We are using options to put time into this decision-making equation. And like I said, the point being is, instead of taking the trend when we see the signal, we buy time so that we can look back into time and say, whoa, that was a great trend. I'd love to be in that trend. And then you go and put yourself back into the trend. And the secondary benefit of that train of thought is that it also avoids you being stopped out too soon. We've shown you examples of how the market spikes up, triggers your stop loss, and then go in the direction of the trend. And this kind of gives you the ability to avoid all of that noise. So I hope this makes sense. Again, if it's the first time that you experienced options, remember you can play this video over and over and over until it makes sense. But also remember that we have very regular webinar sessions. And during the webinar sessions, we have live Q&A with the audience. And we can very easily cover this type of topic in a webinar scenario. There's so much you can do with options. And like I said, you have to take it step by step, baby steps at a time. But once you understand how these things work, it is phenomenally powerful tools. All right, so on to the next video. I'll speak to you in section 12. Thank you.